Welcome to the Early Stage Investor, where life-changing returns are the only priority. Make sure to visit silverchartistnation.com for a free weekly chart pack covering early stage assets ready to lift off. Now, here's your host.
I want to welcome Brynne Kelly. She is the founder of the Fundamental Angle and director of research at Cornerstone Futures, and is a true industry expert with 25 plus years at top energy companies and hedge funds. Welcome, Brynne.
Well, thank you for having me.
No, thank you for being here. We're really excited to hear your take on this space. And, we're all about finding undervalued early stage assets. And I'm one of the rare few that think that oil and natural gas assets have that potential because, a lot of them have been left for dead given the green energy movement. But I saw a chart showing that crude oil demand will skyrocket in China. So I want to ask what your thoughts are regarding the long-term supply demand fundamentals of these commodities.
Great question. And, whenever a market has had a lot of movement or a lot of volatility and kind of there've been some reports or forecasts circulated through the market, you start to take a little bit of a look, right? And so I think it's a good opportunity to kind of understand maybe a little bit of how we got here and what some of the, trajectories from here might be. And I, my background, I traded in the energy space, like you said, for 25 years. So I come at this from a real in-depth understanding of the commodity markets. And I'm hoping that my interpretation of that will help you apply that to certain investments, vehicles out there in the market, not necessarily just oil or gas futures.
Yeah, that sounds good. I mean, just whatever your fundamental analysis is can obviously relate to potentially a move in the price and then therefore a move in the derivative assets of those like tankers or explorers or whatever. So
absolutely. Yeah. Prior to 2020, because obviously that was a year of just massive change in valuations in a lot of things. But prior to 2020, and I'm going to start off with the oil markets, but it's really true for natural gas as well. Natural gas just has a little bit more of a seasonal component to it. But prior to that, the U.S. had been ramping up production ahead of the removal of the export ban. And so capacity was being built out across the country, and specifically in the U.S. Gulf Coast. So if we're going to start exporting barrels, you need to have loading terminals and pipelines that go to those terminals, and you have to increase the inventory space you have down and around the Gulf Coast, which is a shift from where it used to be, and it still is, which was Cushing, Oklahoma. So suddenly we had to kind of build up this infrastructure and fill it up. And so from 2016 to 2020, we had been ramping up our production, especially in the Permian, which is West Texas, and in the Marcellus region in kind of Pennsylvania, Ohio area, and a lot of infrastructure, pipelines, and just things to make a system work in a different direction had to be built up. And during that time, we accumulated a lot of excess inventory because, we were ramping up production in anticipation of this additional capability, which would be to export oil. The thing to remember is that the marginal barrel produced in the U.S. is not needed for U.S. demand. It's needed for demand in growing countries like Asia, like India. So, of course, it was important for us to tap into that export community and participate in, some global prices. So we started producing, we built a bunch of inventory, and it got to a point where it was really weighing on oil prices. And finally, at the beginning of 2017, OPEC cut around 1.7 million barrels off the market. And they rolled those cuts through all the way into 2020. So coming into 2020, there was a little bit of, fear, anxiety about whether or not the market had reduced its, excess supply enough for OPEC to back off of their cuts. And we had done a great job through 2017, 18, and finally 19, coming into 20. The picture was looking pretty bullish for crude oil. We'd drawn down enough of the excess inventory. We were participating in the export market. Everything was assumed to be growing at a steady pace. And then suddenly things started to fall apart. We had this abrupt loss of demand. And everybody remembers what happened in March and April when crude, took that huge, big dive lower and then rallied back up. And that garnered a lot of attention. But it also ended up, we had drawn down all this excess inventory over these years. And suddenly, with the flick of a switch and the loss of all this demand, we had built it right back up. And really, that's the problem for oil and for natural gas. Anytime inventory is at its extremes, it causes big bull or bear moves. When inventory is kind of at the 5-year average, it's not as important. And so OPEC had to come out. They had a little bit of a problem in March, but that was really because they were anticipating reducing and eliminating the cuts they'd had over the last 3 years because they had worked. And then all of a sudden we had the coronavirus and everything got turned upside down. OPEC and their, allies ended up cutting another 9.7 million barrels a day from the market. And we have proceeded since then to work off the excess inventory that was built up around the globe during that time period when we had that sudden loss of demand. And so the market feels tighter on a day-to-day basis. The supply demand, keep in mind, they cut 9.7, then they cut, reduced that. And I think we were to 7.7 million at the beginning of January, easing into, we've now got a tighter inventory balance. I think OPEC think they can start adding some more oil back to the market. And that's kind of the crux of all of this in both oil. Oil has a global component to it. Natural gas has such a local, it participates on such a small scale in the global market that it's hard to draw the same analogies as you can with crude oil. Even though you see things about LNG and Asian LNG and the big prices there, we're not really a big participant in that. And so it's not as interesting of a story. But with oil, we've now drawn down this excess and prices have rallied. But what I want to frame up for everybody is that underneath the hood in both oil and gas markets is massive backwardation. And that means that the front of the market is priced much higher than the back of the market. Energy or commodities are valued through time. So unlike a stock, if you buy it and you just hold it and you carry it forward in time, energy futures expire every month. So a curve is looking at the settlement price or the price. There's a futures contract for March crude oil and April and May and June and July. And if you were to put that on a graph and each month's price is a point, what it looks like is a curve. And why is that important? It's important because if you're evaluating maybe a new stage or even a left, as you mentioned, like a left for dead company, you're trying to assess, I would say, one of three things, if I were to boil it down. There is short-term cash flow, and short-term cash flow is significantly impacted by the price of crude oil in the front, right now, the spot market. And that has rallied. And if you were to look at comparing last January to prices now, so a year ago, we're essentially at the same level that we were a year ago in the front of the market. So cash flow on a daily basis is getting better for producers, right, than it was in April. But it's not that different, than it was a year ago. So it's not that compelling of a story for me. Then on top of it, you look at the forward curve. So if, crude futures exist on a time horizon. And so if you were a producer and you wanted to hedge your production for next year, for 2022, prices are still almost $8 lower than the front, and they're at least $5 lower than where they were at this time last year. And so that kind of gets you into the longer term picture of course, companies look good if they've got new cash flow and that's fine. But the other component of a lot of these energy companies is the value of their reserves. And just looking at, in a backwardated market, and especially with a significant premium that the front has over the back, the value of any of these oil, producers or majors' reserves is still lower. And I think that's a component that people miss a lot. They kind of buy into the feel of the spot market and what's going on there, and don't understand that doesn't change. If you have, say, 100 million, I'm just going to make up a number, in reserves, and you sell it, one a month at a time, it doesn't really matter how much the front goes up when it's the value of what's left, right? The proven reserves, the unproduced. I mean, that's what banks assess every year. That's what they do their lending relative to. So the value of, the asset you have left versus the asset that you're producing today. And that's why, when people see, wow, this is a great investment, these companies seem like they're trading lower than, where they were. They've lagged. And I mean, look, everything is making new highs in equities, right? So it's natural to kind of come for some of these energy companies that look cheap relative to where prices have moved in the front of the market. And I just want to caution people to make sure that you understand that the majority of their value is in what's still in the ground and what's unproduced. And that whole back of the curve is significantly depressed. Beyond, I think 2022 and WTI just barely got above $50. And beyond that, everything is below 49. Same thing in natural gas. You can barely get any of, the front of the curve is a clear 50 cents over the future. So if you think something's undervalued, it's probably the future, not the front, if that makes sense, right? And in that way, you can kind of play that a couple ways. You can either buy the future of a commodity, right? Maybe you buy December 22 futures, or, January 23 or calendar 23. Or you could buy and invest in a company that produces, but it's not as clean because you are subject to policy changes and debt agreements and their overhead and all of those things that make it not as clean of a move one for one, up or down, because generally They're not only in the business of producing, right? Maybe they're in refining. And so in that way, unless I see the back of the curve start to get bought, it's hard to buy. Let's put it this way: the front of the market is the highest priced.
Right.
So, in a sense, you would be buying the highest, right? And if you think that's something that can roll forward into the future, you should buy the future at an $8 discount or a 5. I think April 21 to April 22 spread is like, I think this April is $5 over. And in natural gas, I want to say this summer is probably 40 cents over next summer. And then it just continues lower and lower and lower as you go into the future. And the reason that's happening is, we have been through something in this last year that really kind of highlighted or provided the opportunity for a focus on ESG. And in that way, people aren't as willing to invest further out on the curve. They're afraid that there will be too many regulatory hurdles that will keep it from, while we have a manufactured tightness in the market right now, because we're literally, just OPEC Plus is withholding almost 8 million barrels a day from the market. So you almost think that's something that reduces your upside call, right? Because you've got this potential supply just sitting there waiting. Now, the good news is it takes a little while for physical supply to get on the market. And so the front of the market could certainly spike a lot more. And, I just worry that gets a lot of people excited without understanding how that's filtering through to the rest of the curve. If you're only buying right this minute, it's like Valentine's Day and roses, right? You pay a lot more to have them delivered on the 14th than you would pay to have them delivered on the 20th. And just because you had to overpay for delivery on the 14th doesn't mean you're bullish suddenly, the entire rose market. Does that make sense?
It does. And I want to make sure I absorb that correctly. So,
okay.
What you're saying is that we, back in 2020, we had kind of a supply glut, but we've since drawn down that excess. Now we're back to kind of a normal level, but you're still seeing a depressed long-term demand. And that's why you're cautioning people from seeing these undervalued oil assets as potentially great bargains if there's a lot of headwinds ahead, right?
Yeah, and that's an interesting way to put it. It's not necessarily depressed long-term demand. I would say it's depressed interest in it. So the belief is that going forward, there will be more hurdles for fossil fuels to reach the market. And what do I mean by hurdles? One of the big components of the energy markets is these renewable obligations. So if you produce, for example, gasoline that is consumed in the US, you are obligated to buy a renewable credit to offset that. So let's say you produced a gallon of gasoline that was consumed in the US, you have to buy or manufacture yourself or blend into it about 10, 20% of some sort of biofuel, ethanol, biodiesel. And it's those types of obligations that are, nobody wants to grow that overall production because then you're growing your obligation. And at the moment where the market is focused on how can they participate in these tax credits provided under these renewable obligations. And an example of that would be refiners. So even though oil prices have recovered in the front to where they were a year ago, refining margins are still depressed. They're certainly recovered, but they're not at last year's levels. And on top of it, they have all of these obligations. So in order to increase margins, refiners are looking to try to produce biodiesel so they can capture an extra $1 or $2 of credit on the bottom line, tax credit, because you get a rebate if you produce these. And that's where I think the future is. It is, and I'm not saying refiners, but it is in something like a refiner that could reconfigure, right, and maximize their return by incorporating or producing more of these renewable type of volumes, because it's clear that's where we're going. I don't see these mandates going away, especially with the new administration, or becoming a producer of one of these renewable offset credits by producing biodiesel. So there are refiners that are starting to, I think biodiesel comes from waste or cooking oil, used cooking oil. And over the last year, because all the restaurants have been closed, there hasn't been a lot of used cooking oil to make into biodiesel. And so that there's a whole underpinning of rallying going on associated. Then they have to go to soybean oil and try to use that. And you've seen agriculture has been rallying. So everything is kind of intertwined and connected. But the general theme is, people are nervous about making any kind of long-term commitment to fossil fuels from an optics standpoint or whatever. So I would focus on things like companies that somehow have a technology that reduces, you think about a refiner and you would have somebody that maybe has a technology that can cut, their emissions out of some hydrotreater or something and reduce it, things that can help them continue to produce, but offset that pollution game. Or flexibility, people that have flexibility to move to whichever market has the most premium. When you produce out of a well, you can get crude oil, you can get natural gas, and you can get natural gas liquids. And, along that value chain, if people have flexibility and also geographic location, as the U.S. used to be the growth engine for consumption of oil products and of natural gas. Again, natural gas more of a local market. Now we're not. We're an exporter, and we're looking to Asia and to India for their growth. And in order to export, you've got to compete. You've got to have shipping rates in your favor. You have to have spreads in the market in your favor. So I think there's going to be some more positioning going forward of supply located closer to demand versus having, you think about, we're in the U.S. Gulf Coast. We're not really that geographically advantaged to getting to Asia. There's a lot of problems at Suez Canal and at the Panama Canal. They're congested. They're kind of at capacity at what can go in and out of there. So you can't really grow that unless, they do another dredging of the Panama Canal, right, and make it even wider. Or, logistically, you'd be better if you were a U.S. company that bought, production more geographically preferential, right? Because everybody's going to be competing going forward to get the product to the demand centers. And that's just not the U.S.
I got
Now,
you.
that being said, of course, what everybody is going to look at tomorrow night and Monday, natural gas, it's a huge problem in Texas and Oklahoma. they've hit freezing temperatures. Prices for this weekend and next several days have traded as high as $200 or $300 an MMBTU, and that gets everybody really excited. But that's a price at a constrained pipeline point on the system. And, once that condition goes away, It's not to say that it doesn't elevate the entire complex to a new level, but, 1 or 2 days at exorbitant prices followed by a return of normalcy to a system, just don't be careful not to get caught in the front telling you that that's what the back of the market is going to do. It sometimes does. It definitely sometimes does. But, we only have a fixed amount of export capacity for LNG. So I think, a month ago, we heard about these $30-some prices in LNG in Asia. We can't send more than we already are sending out into the market. And same with crude oil. There is a capacity amount of exports that we have. So if you want to get real bullish on any of, these companies, you have to believe that the forward curve will lift in value, because right now you're staring at the future that is just declining rapidly every month. That's the structure of both the gas and the oil curves. Massive decline as you move forward. That's not usually a market that people say, wow, right? I think the future looks cheaper. I'm going to produce something there. Usually it's that you see some skyrocket, right?
Yep.
And so in that way, I like the exuberance and it's really been, it's exhilarating to watch natural gas come to life a little bit in the spot months, and it gets eyes on it and investment dollars. And, I think there's either you can play a short-term momentum, but don't translate that into like a long-term investment unless you see the forward curve moving. But if next month is 50 cents lower than this month, and then that next month is another 50 cents lower in the following month, it's not a structure unless you see people saying, in theory, people should say, wow, 2022 is where we're going to really have a problem. I should buy that at a $6 discount to today. But the fact that this backwardation is exploding tells you that people expect this to be a short-term condition. We are short-term. We have a supply-demand imbalance potentially because we are actively withholding production from the market as we recover from one of the most, iconic losses in demand that we've ever had. So the front of the market is going to be incredibly volatile. And I think it was great that you had me on just to talk a little bit about how to, put that in the context of the future. And the future really of margins is flexibility, location, and, how much they're hedged, right? What their mix of business is, if they can pivot and not at the investor's cost.
Right. And, that's a really wise way of looking at commodities. It's just, you can see a short-term spike, but there could be some very short-term fundamental drivers behind that, and it won't translate necessarily long-term. But my question really is that, and this is my philosophy, and poke as many holes in it as you want, but
Okay.
So yeah, oil is almost taboo now. No one wants to grow production given the green energy regulatory environment. But given, the projected demand growth around the world, not just the US, it seems like, it's all building towards an eventual supply squeeze, right? Because if the supply is diminished big time, like what you're talking about, very low interest in future production, but the demand, in China, the bigger countries in the world are growing, China, India, don't you see, or, potentially a supply demand imbalance long term, and maybe a squeeze and supply crunch that would spike the price of these assets.
It's certainly a narrative that could happen. What I would say, though, is think about the potential capacity sitting around, right? So the U.S. is producing 2 million barrels a day less, right? The OPEC Plus is producing 8 million barrels a day less. You've got other countries producing less. And certainly nobody wants to turn on the spigot too soon, because nobody wants to take this fragile recovery back to almost $60 and just pour water on it, right? But there is the potential for that. If OPEC came in tomorrow and said, all right, all 8 million barrels are coming back online, be crushed. What everybody's counting on is that OPEC will, and they have said, we're only going to increase our production 500,000 barrels a month. So that's why, the future is less valuable than today. So in the short term, it could be, you can't turn on, the spigot and have it delivered tomorrow, right? So I certainly think the oil market and the gas markets are vulnerable to a short-term squeeze. I don't yet know how that would translate to the future, only because we are not, in other times when think about when oil was above $100 and pre the Beijing Olympics, and China was buying up everything, right? And oil was up to $100, $140 a barrel. Everybody was producing. We were in a growth mode. Right now, people are trying to describe a scenario under which we have we're going to underspend because people, have been burned, and their investors are requiring a little bit different discipline, right? They're not ready to just pour money back in and say, keep drilling holes, right? We want you to be a little reserved. And, it's just a scenario that is not, we're not looking at massive demand growth like we had in these other years, because we've implemented all these ESG and all these, pollution and climate commitments on top of everything. And I really think the problem is going to be in meeting those goals, 2030 goals, right? Net zero, all these commitments that you see out there. The only way that they're going to be able to meet that is by buying whatever carbon offsets the government allows, right? They change, and different countries have different categories. If demand really is going to grow, the need for these carbon offsets, unless if you believe that some of these mandates are going to go away, but it feels like the market is pretty comfortable in, committing to these net zero, right? 20 carbon neutral and whatever dates they set. Some of them are not that far out now. And the only way to meet them, because we're still in a fuel economy, is to buy offsets. And I think it's an interesting kind of weird, fake, regulated, manufactured market, these renewable credits, because there's so much government involvement in them. But I don't really see how else we can keep producing without buying more of these offsets or changing the rules, right? Change the rule to say suddenly this isn't as bad as we thought it was.
Right. So because a lot of people are thinking that, oh, well, we can just do solar and wind in 5 years and that'll cover it all. We can get rid of oil completely. But have you crunched some of the numbers about what the renewables can actually do, compared to the oil market, to make you feel like they will, renewables will never meet that demand, at least in the near term?
Well, there there are dreams and then there's reality. And the reality is that not that much of our current global energy usage is fueled by wind and solar. They certainly have nice exponential growth numbers. And I do think that's probably that's the direction we're trying to move towards. And I think, the world runs on energy. So if we're going to change what that energy source is, that's, fine. It's a massive supply chain, right? So that's not going to happen in 5 years. I guess I shouldn't say it's not going to, but, our physical delivery system is not set up to handle most, moving much beyond where we're at. And we saw that in Texas, the end of last week and into the weekend, and I'm sure we'll see that next week. They probably have, as a percentage, the most wind resource. Maybe Cal ISO has more. I'd have to go back and look, but they've got about 10 in ERCOT, 10,000 megawatts out of their 70 or 80 that are on wind. And it's been cold down in Texas, and the wind hasn't been blowing. And so we've taken a product, real-time electricity prices that has been, normally is, let's call it $30 a megawatt hour, has been trading $4,000, $5,000, because they don't have the wind. They have a lot of cold. Their usage is at capacity. And so they're having to dust off, less efficient resources, and also price scarcity. That's really what's happening when the price goes up, because nobody could argue that we don't have enough oil, natural gas, or electricity on a given day to meet all of our demand. What we don't have on any given day is enough delivery capacity. So let's say on any given day, we have the capacity to deliver 10 units of an energy product across the country. And some days we need 6, some days we need 9. And the difference is made up through storage, right? To kind of smooth out the differences in demand. But on days when we need 12 or 13, the market jumps up and prices the scarcity of delivery capacity. And so that's what's happening right now, right? We're just pricing this short-term scarcity, but it doesn't mean like we don't have it. We have the resources. You could look at the reserves across the world, right? The storage, we could drain, all our storage on any given day, right? So it's more that we don't have, like, for example, in New England, there's not a lot of pipelines coming from, into Massachusetts. And so their spot prices in natural gas can go to $100, $200, $300, and you can't get it there from anywhere else. It's not like that price is trying to incentivize someone to get it in there. What it's trying to do is get rid of demand. That's how you allocate a scarce resource. And so keep that in mind as you're seeing some of these. It seems like next week people are really excited about this cold weather, and seems, like everybody's expecting a rally. And I'm just saying, keep in mind that, they're pricing today's scarcity, not future scarcity, because we can rectify that, right? Just by drilling more or turning more on. So it's more, what lasting impact might that have? And the lasting impact is that we draw down from storage a little bit too much than we feel comfortable, right? And so the market's bid up to refill that. And that would be where a future bid would come from. So, there's a lot of ways to look at it, but just don't get caught up in that what market action in the front is just a black and white transference into the future value of a company, especially when you know that all that happens as you move forward in time is that the product decreases in value.
I gotcha. And, just so to be crystal clear, so you're saying that there could be a bid in the price of oil and fossil fuels. There's going to be a lot of demand in the price of oil. You're saying there is vulnerability for a squeeze in the price of these assets to meet that demand because the supply has been so reduced. But
that's right.
Way long term, you're saying, well, we'll just pump out the oil. OPEC will pump out the oil and bring us right back, in line, and the price will go back down again, most likely.
I mean, at a high level. I mean, look, it's not that simple just to pump it, but look, we have a lot more levers to pull as every year advances. There's always more levers that can be pulled by consumers, and that can range from not using less, using an alternative such as an electric vehicle or whatever. The pool of alternatives is growing as well. And so, you have to count, say at what price level do people just say, like, I don't even care if, the economics of EV versus oil, like I'm just going to I don't want to be caught up in that whole thing. I'm going to move to electricity, or I'm going to move to hydrogen, or, whatever the fuel is. And of course, hydrogen is certainly being touted out there as maybe a better bridge fuel than natural gas. And so there's, it's find the company that isn't too legacy and forward thinking enough to pivot either in location, in flexibility, or just, maybe short lead times, right? But that's back in flexibility. I mean, those are really the key things that you would want to look for. Somebody, BP, I mean, they're massively trying to turn the ship, but could you imagine if you're buying them just purely for the move higher in oil when they've said, we're not going to be an oil company anymore?
Right. No,
I'm sure in the momentum of it all, like and that's a whole different thing. Like, if you want to trade momentum, that's fine. But, you're going to look at a company and say, and I worked at BP, for 5 years. So but for them to completely be pivoting, it's hard to say like, oh, let's get BP, oil's going to rally, when they have clearly been saying, we're going to move away from that. We're no longer going to be that company. It doesn't mean they're not still that company, but imagine the debt and how laden everything is. That's not a very pure play.
Yeah, no, I hear you. But the bottom line is there's a current asymmetry in the fact that the supply is shrunk and the demand will grow. And then there probably be a bit of a squeeze in that window. And I think that's honestly what a lot of people are excited about right now, that potential squeeze.
Grow. Can I use air quotes around that? I mean, we're certainly expecting it to resume 2019 levels by maybe 2022. So grow from, the massive reduced level that we had. It's resumption of the future trajectory of growth that I'm worried about. We have been growing X% every year, X%. We take this big hit, and now we're climbing back to break even on growth. Now, could you sit down with a group of your peers and have a conversation about in 3 years you think oil demand is going to go through the roof? Because it doesn't feel like that's what people are saying as far as where they believe the future of energy is.
No, but I've talked to a few people that are excited about the growth in the developing countries because China's still projecting some serious growth, record growth in oil, I believe, and same with some of those developing countries. So,
India and China are the two big ones, right? And absolutely. Now they're also getting held to, and I feel like I talk about climate. I'm not, I'm I don't have, an agenda on either side. I just am trying to read, so where I would put my money. And, the world is imposing on each other these mandates, right? Nobody wants Iran to suddenly, amp up their nuclear powers, right? Even though nuclear is a good source of electricity. Nobody wants that. Nobody wants to see China saying, woo, we're growing our coal production, right? People will put emissions and stuff on that. So, that they have more things at their disposal as well. But for sure, what do we think the future economic growth will look like? I hope it's growth. I hope it's growth in use of energy everywhere. I'm just wondering if the difference, the growth, is really going to be more weighted towards other, the efforts are going to be spent towards other greener options.
Yep.
Now, what that could do is lead to kind of this beleaguered, faction of the world that's trying to continue to produce gas and oil, and in a world where that's not the future. And in the meantime, it's so scarce as less and less people are involved. And all of a sudden, we skyrocket in prices. And that's a sad scenario, right? It could happen. But that would just kind of force the hand even faster. Like if all of a sudden it was $10 for you to fill your car with, you're just like, I'm not, right. I'm not doing that. Right.
Yep.
And we lost a lot of demand when oil was $150 a barrel too, right? And then it crashed to 35 or 30, right? And now we start another cycle. So it's whether or not you think we could have the same unfettered future growth in the demand of energy that we have in the past. I think, we will, but I think it will look different than it has before.
That makes a lot of sense. I totally agree with you. It won't grow as fast, certainly, because other energy sources are going to take away some of the market share, but the asymmetry is exciting. So. Yeah,
definitely. And look, I love eyes being on energy markets, right? I mean, that's what I do. So, I welcome it, but I do want, I just don't want anybody, if you're playing momentum, you play that, right? Then don't even listen to this, right? I guess you don't need to know any of this, but if you're trying to find a smart investment, cut through some of the front stuff. Just don't let it get you too caught up. I'd say buy front month futures and then, invest in some other technology for the future. So you can catch the front month volatility, right? And yet diversify into the future.
Absolutely. And, I'm really excited to have had you on to get that expert take. It's a very balanced approach. You really brought that experience and deep knowledge of the field. So it's been very refreshing to get that. So where can people go to learn more from you?
So I'm on Twitter at Brynne Kelly, and I post a lot of my curves. So the curves that I've talked about today and charts and information. I also publish weekly research through Cornerstone Futures, and that's at cornerstoneglobalcommodities.com. And there's a weekly in-depth analysis of all of these concepts that I'm talking about, curves and relationships and timing and spreads. And I try to visually represent that and have some narratives about it. So, both places I encourage people to go and look and learn.
This discussion is for informational purposes only. Nothing in this discussion should be taken as investment advice. Guests are not compensated for their appearance. Do not base any investment decisions on the information presented. This video contains an affiliate link. While it will take you directly to Steve's brilliant free newsletter, if you do decide to make a purchase on the website, I will receive a small commission. In full transparency, I wanted to disclose that to you.